How Investors Qualify Without Tax Returns, a masterclass with Lisa Stepp. Hi, I'm Lisa Stepp, a mortgage advisor and educator with more than 25 years of experience helping real estate investors finance properties across the continental U.S. Today's session is called How Investors Qualify Without Tax Returns. We're going to break down how DSCR loans work, what lenders really look at, and how you can qualify for investment properties using the income from the property instead of your personal tax returns. This is especially helpful if you're self-employed, have complex returns, or you reinvest a lot of your cash flow and don't show big net income on paper. Let's start with the big picture. Qualifying based on the property, not your tax returns. DSCR stands for Debt Service Coverage Ratio. In plain language, it's a way for lenders to ask one key question. Does the property's rental income cover the mortgage payment, taxes, and insurance? Instead of digging into your W-2s or tax returns, DSCR lenders focus on how the property performs or is expected to perform. That's why investors can qualify without providing traditional income documentation. Here's the basic formula many lenders use. Monthly rent, or expected market rent, divided by monthly mortgage payment. Principal, interest, taxes, insurance, and HOA, if applicable. If that number is 1.0, the property's income equals the payment. Different lenders will have different minimum DSCR requirements. Some are comfortable at 1.0 or 1.1. Others want 1.15, 1.2, or higher. Let's take our first audience question. So, just to be clear, Lisa, does this mean the lender never looks at my tax returns at all? Great question. With true DSCR loans, the focus is on the property's cash flow, not your personal tax returns. However, lenders still look at your credit, reserves, and overall profile to make sure you're a responsible borrower. Now let's talk about what DSCR lenders do look at. First, property income. Second, credit profile. Third, loan to value and down payment. Fourth, reserves. And finally, experience and portfolio. For long-term rentals, we use the actual lease or market rent. For short-term rentals, we use a combination of history, market data, or a specialized STR appraisal to estimate what the property can generate. Question from the chat. Can I use Airbnb or VRBO income if I just converted a property to short-term rental this year? It depends on the program. If we don't have 12 months of history, we lean on market-based projections. The key is to show a realistic, lender-approved picture of what the property can earn. Now let's walk through the process. Step 1, strategy call. Step 2, pre-qualification. Step 3, application. Step 4, appraisal and DSCR calculation. Step 5, underwriting. And Step 6, clear to close. Throughout this process, my job is to help you understand which levers matter, DSCR, LTV, reserves, and how to structure your plan so you're using the right financing tool for your strategy. Question from the chat. What if I already own several properties and my debt-to-income ratio is tight on paper? This is exactly where DSCR loans shine. Instead of stacking more payment obligations onto your personal DTI, we focus on whether each property can stand on its own. You can often keep scaling when traditional DTI would say you're tapped out. Let's clear up a couple of misconceptions. DSCR doesn't mean no documentation, it means different documentation. And it's not just for big investors, it can work for first-timers too. One more thing, DSCR loans are powerful tools, but they're not magic. We still need to make sure the property is sound, the numbers make sense, and the loan fits your broader plan, not just this one deal. Last question from the chat. Is there ever a situation where you do recommend using tax returns instead of DSCR? Yes, if you have stable income and a simpler property, traditional loans can sometimes offer better pricing. My job is to help you compare options so you're leveraging the most efficient tool for your strategy. Let's bring this together. DSCR loans allow investors to qualify by focusing on the property's cash flow. If you have complex returns, DSCR can unlock opportunities that a conventional loan might block. If you're ready to talk about your specific scenario, visit lisastepp.com and click to book a strategy call. I'm Lisa Stepp, and I'd love to help you finance your next move with clarity.